Before we begin, let me ask you something. If you currently have money in the stock market or savings connected to the global financial system, have you ever wondered how secure that system really is? Because after spending most of my life observing markets, businesses, and economic cycles, I have learned something that many investors only understand after experiencing a crisis. The most dangerous moment in any financial system is not when panic begins. It is the quiet period before anyone realizes that the system is about to change. Markets look stable, headlines sound optimistic. Confidence spreads across investors and institutions. And during that calm moment, most people believe the future will look very similar to the present, but history rarely works that way. That quiet confidence has appeared before almost every major financial storm, before the collapse known as the Great Depression, before the global shock of the 2008 global financial crisis. And when I observe the world today, I cannot ignore the uncomfortable similarities. History may not repeat itself perfectly, but it often rhymes, and the rhythm of financial history usually follows a familiar pattern. First comes optimism, then expansion, then confidence grows stronger with every passing year. Risk slowly accumulates beneath the surface, almost invisibly, until one unexpected event reveals just how fragile the system truly was. I remember studying the economic boom that preceded the Great Depression. During the 1920s, many investors believed they had entered a permanent era of prosperity. Stock markets climbed year after year. Banks extended credit more aggressively. Businesses expanded rapidly, and ordinary families believed the future would continue improving indefinitely. Few people imagined that such a powerful economic system could collapse so quickly, but in 1929, it did. Markets crashed, banks failed, entire industries contracted, millions of people lost their savings, not because they were reckless, but because the system they trusted proved far more fragile than anyone expected. That crisis taught one of the most important lessons in financial history. Stability often hides risk. Decades later, the world faced another moment of extraordinary tension. During the Cuban Missile Crisis, humanity stood dangerously close to nuclear war. For 13 days, the future of civilization depended on a series of delicate decisions made behind closed doors. Most people going about their daily lives had no idea how close the world came to catastrophe. History often moves quietly until suddenly it doesn't. Then came the modern financial era. Markets became larger. Capital moved across borders faster than ever before. Technology accelerated global trade. For many years, investors believed the financial system had become more sophisticated and therefore more stable. But in 2008, that belief collapsed. The 2008 global financial crisis revealed something deeply uncomfortable about modern finance. Systems that appear strong can unravel much faster than anyone expects. Major financial institutions collapsed. Credit markets froze. Governments around the world were forced to intervene on an unprecedented scale. Millions of people discovered that the wealth they believed was secure was actually connected to risks they never fully understood. During that crisis, I once read the story of an investor who had spent nearly 30 years building his retirement portfolio. He believed he had followed every sensible rule. He diversified his investments. He avoided speculation. He trusted the financial system to function as it always had. But when the crisis struck, something unexpected happened. Nearly every investment in his portfolio began falling at the same time. Stocks declined, funds lost value. Even assets that were supposed to provide stability were suddenly under pressure. And in that moment, he realized something that many investors rarely consider. Diversification inside the same financial system is not always protection. Sometimes it is simply different doors inside the same building. And when that building catches fire, every door leads to the same outcome. That experience revealed another powerful lesson. Complex systems rarely fail gradually. They fail suddenly. Now we arrive at the present moment. The year is 2026. And after watching global markets and geopolitical developments for nearly a lifetime, I must tell you something honestly. The world today feels unusually fragile, not because there is one single crisis, but because several powerful pressures are building at the same time. Consider the geopolitical landscape. The war triggered by the Russian invasion of Ukraine has reshaped the security structure of Europe. Energy markets have been disrupted. Military alliances have strengthened, and global tensions have intensified. At the same time, strategic rivalry between the United States and China continues to grow. Trade disputes, technological competition, military positioning across the Pacific. At the center of that tension lies Taiwan, a relatively small island that produces a majority of the world's advanced semiconductors. These tiny pieces of technology power nearly every modern industry: artificial intelligence, medical equipment, automotive systems, defense technology. If that supply chain were ever disrupted, the shock would move through the global economy almost instantly. Meanwhile, instability across the Middle East continues influencing energy markets and geopolitical alliances. Individually, each of these tensions would already be significant. But what makes this moment different is their convergence, multiple fault lines appearing at the same time. Geopolitical rivalry, economic uncertainty, technological competition, and financial systems increasingly used as instruments of political power. History becomes unpredictable when too many pressures build simultaneously. Now, let me make something very clear. This is not a prediction of imminent catastrophe. Human civilization has faced extraordinary challenges before: global wars, economic collapses, pandemics, political upheavals. And yet the world continued moving forward. New industries emerged, new technologies reshaped the global economy. New opportunities appeared, but throughout every period of uncertainty, the same pattern has always separated successful investors from the rest. Preparation is always cheaper than reaction. Investors who prepare before uncertainty arrives retain options. They maintain flexibility. They preserve the ability to act when others cannot. Those who wait until panic dominates the headlines often discover they are already too late, because markets move faster than emotions. By the time the public reacts, disciplined investors have already repositioned themselves. So the real question becomes simple: how should thoughtful investors prepare for a more uncertain world? The first principle may sound surprisingly simple: liquidity. Many investors see cash as wasted opportunity, but experienced investors understand something different. Cash is not laziness. Cash is optionality. During calm markets, cash may appear unproductive, but during volatile markets, cash becomes power. It allows investors to move when others cannot. It allows them to acquire valuable assets when fear drives prices downward. The second principle involves resilience. Not all companies survive economic storms. Some collapse under pressure, others emerge stronger. Historically, businesses that provide essential services tend to endure. Energy infrastructure, food supply systems, transportation networks, healthcare services. These industries form the structural backbone of modern civilization. And when uncertainty rises, their importance becomes even more visible. The third principle involves geographic diversification. For much of financial history, investors concentrated primarily on their domestic markets, but the modern economy is global. Capital flows across borders instantly. Supply chains stretch across continents, and geopolitical events in one region can influence markets everywhere. Diversifying across multiple regions helps reduce exposure to localized shocks. The fourth principle involves strategic assets. Throughout history, certain assets have consistently served as stores of value during periods of instability. One of the most enduring examples is gold. Gold does not innovate. It does not generate dividends. It does not produce earnings reports, yet it has survived every financial system humanity has ever created. Empires have collapsed. Currencies have disappeared. Governments have risen and fallen. Gold simply remains. That is why central banks around the world have quietly increased their gold reserves in recent years. Not because gold is fashionable, but because uncertainty has increased. But perhaps the most important principle in investing has nothing to do with markets at all. It has to do with psychology. During every crisis in financial history, the same pattern appears. Emotional investors react. Disciplined investors prepare. Markets reward patience. They reward calm thinking during moments of uncertainty. There is an old observation about financial markets. The stock market is a device for transferring money from the impatient to the patient. History has confirmed that truth again and again. So let me leave you with one final thought. The future has never been predictable, but one thing has remained remarkably consistent throughout history. The investors who survive periods of uncertainty are rarely the ones who react the fastest. They are the ones who prepared the earliest. Preparation is quiet, panic is loud, and by the time panic dominates the headlines, the prepared investors have already moved. So the real question is not whether another crisis will eventually appear. History suggests that it will. The real question is much simpler. When that moment arrives, will you be reacting like everyone else? Or will you already be prepared? Because in the end, the future rarely rewards the fastest reaction. It rewards the calmest preparation.